Okay, so I want to pose a question to you. Should an asset's value differ based upon the type of valuation model that we use to estimate that value? What do you think?
You ask again?
Should an asset's value differ based upon the type of valuation model we use to estimate the value of the asset? Should the model that we apply to this change the value of the asset, or should the value of the asset be constant regardless of what model we use?
Well, it would have to change, otherwise why would you ever use another model?
Interesting question. Okay.
It changes continuing value.
It
Like
does.
with KVD, for example, we calculate it different than with FCF.
So are you talking about assets value in this moment?
At any moment. So here we are, we're looking at Mira Dravana. And I know I'm not sharing the screen at the moment, but I will get it in a few minutes. But we're looking at Mira Dravana. And we see that whether we use the free cash flow model, KVD model, the adjusted present value model, or something that I will refer to as the forward market multiple, FMM, forward market multiple model, we get about the same value, right about 600. And I'll tell you that if it varies 1 or 2 here or there, to me, that's the same. That's such a slight variance as to not be a variance. So Matt raises an interesting point where he says it has to, otherwise, why would we use different models? So I will tell you that we use the type of model that appears to be the most appropriate for the kind of company we're dealing with. If we're dealing with an early stage company that doesn't have any profits yet, is a free cash flow model appropriate? It's really not. It's going to give us a negative value, right? We know that's not right. This could be one of the most promising companies on the face of the planet, and it's going to come up with a negative. Oh, that's not right. Or a company that doesn't have any meaningful debt. We would never use the adjusted present value model, right? Because there would be no tax shield. So we use the model that is the most appropriate for the kind of asset we have. And I'll take us back to the first night of class where I said there are three very basic, very different model forms or ways of thinking about a company's value. We think about it from the asset-based valuation or the book value of the assets. So what those assets cost us to acquire minus accumulated depreciation, that would be the book value. And a variation on the asset-based model would be a fair market value for those assets. So if our company has trucks and a warehouse and production equipment, we might find the depreciated value of those assets on the balance sheet. And we would say that those all total up, plus the current assets, those would all total up to be the total asset value. Now, that might be similar to the fair market value of those exact same assets. You'd have to have them assessed, right? You have to have some kind of a appraiser come out and say, well, that piece of equipment now is only worth X. You're carrying it on the balance sheet at Y, so there's a difference. But those would both be asset-based models. We agreed that there was a way to value something, and we thought of it as a market value. So whatever the value is in the market today, based upon transactions of buyers and sellers, we easily look at the real estate market this way. We easily look at the car market this way. We look at the stock market this way. You have millions of buyers and sellers on any given day. They're bidding, they're asking. We have prices for common stock, preferred stock, and we would agree that there is a market value. And then we said that there was something called a production value. And the production value is trying to identify the value of the asset based upon what it produces for us as investors, not based upon what it produces for consumers or other businesses, but based upon what it produces for us as investors. And that would be a production value. And I will remind you that the valuation structures we've used thus far, free cash flow, any other cash flow, KVD, APV, Those are all income-based, production-based models. They're all discounted cash flow models of some type. The company or the asset produces cash flows for us. So a production-based model or an income-based model would be these discounted cash flow models. But there's another one, and it was that market value. So how do we think about the market value of a company? An asset is so complex that it's a whole company. Well, we look at the prices in the market today of its common stock, of its preferred stock, of its debt, separate out the cash. That gives us an enterprise value. That's its value. But that's calculating it from known values, not estimating it from future expectations. We need to think about how to value it based on future expectations. After all, that's what all production-based or discounted cash flow models are doing, but they're doing it from a cash flow basis. We now want to think about doing something from a market basis. Does that make sense? Any questions about any of that before I move a little bit further into this concept? Okay. Any of you own a home? Raise a hand. Okay. Michael, so when you bought your house, condo, house, townhouse, whatever it is, how did you decide what a reasonable price was for your house?
It was more like what down payment we could put down, and then relative, yeah, I guess it was the down payment relative to the mortgage and all that.
Okay. So that tells you how you financed it, what percentage down, debt to equity, that kind of thing.
Well, we kind of went in with the down payment, like our upper max of the down payment, and then kind of worked from there.
So what you identified was how much house you could buy, not how much was this house worth.
Right.
Or that house, or the one across the street from it. Okay.
Right.
How do we identify what those different houses would sell for or would be worth?
There's comps in the area, right? So it's kind of use.
So when you say comps, what do you mean, Michael?
So you can look in the area. Real estate agents will do that. It's kind of what you pay them for a little bit, is doing, looking at relative or basically comparing prices, similar houses around the area with similar features.
So a house that might sell for $100,000. And when I say might sell for, one that sold for $100,000. I don't know where that house is, by the way. But a house that sold for $100,000, if they had 3 bedrooms, then we would say that it would sell for about $333,000 per bedroom, right? 3-bedroom house. We would think of comps being based upon square footage, based upon number of bedrooms, maybe based upon bathrooms, based upon lot size, based upon condition, based upon, all kinds of observable characteristics. So we could categorize houses. These are 5-bedroom houses. These are 3-bedroom houses. A 5-bedroom house would be expected to sell for more than a 3-bedroom house, and so on. These are comps. Location, location, location. These are comps, right? We've all lived this world. Is there an equivalency when we're talking about companies?
We use like there's the return rate that we use as a comps, right? For like industry.
Well, we certainly do on a proportional basis. ROE, ROA, IGR, SGR, growth, all of those things, profit margin, operating margin as percentages, all of those. They help us know something, but they don't help us compare the value of one business versus another because they're all proportional.
Another one of the things they've talked about, like Tesla valuation, is really hard because some people value it as a tech company, some people value it as a car company, and it behaves a little bit like both. And so there wasn't really a comp.
Right?
Right.
Yeah. So I want to think about this. I want to introduce a class of valuation multiples referred to as enterprise value multiples. I'm going to bring up my screen now so we can all look at the same item. So I believe you're now looking at my PowerPoint showing enterprise value multiples, right? And these multiples are exactly what they say they are. They are a very simple way of thinking about a value. If we have either calculated or estimated a company's enterprise value, and if we then divide it by its sales, we're going to get a number, right? It's going to be some ratio. And we can look at companies based upon that ratio. So I can do the same thing with EBITDA. I can do the same thing with EBIT. I can do the same thing with free cash flow. These are all enterprise value multiples, which simply means enterprise value is the number in the numerator. The number in the denominator is some cash flow unit. But it's still EV divided by sales gives us a number. EV divided by EBITDA gives us another number if it's for the same firm. Could give us the same number if it's for a different firm, right? These are simply numbers. And if I want to think about what these numbers should look like, I can look at different places. I might look at my income statement and balance sheet. So let's go to Mira Dravana. And notice, remember, that when we went to Mira Dravana, we came up with an enterprise value. And then we went and divided that enterprise value by EBIT to give us an EV divided by EBIT number. Well, that EV EBIT number is a valuation multiple. In fact, it's usually referred to as an EBIT multiple. You don't refer to it as an EV EBIT multiple. It's an EBIT multiple or a sales multiple or an FCF multiple. Okay? Well, I know that based upon the market value of this company, its enterprise value, as of the end of 2019, which was assessed by looking at the market value of the debt and the market value that we were given for the common and the preferred and then subtracting cash, I know that this company's enterprise value was 3.09 times its EBIT. Okay? It's a number. So could I take another company that is in the same basic channel of business, maturity level, growth dynamic, etc., and could I take and multiply its EBIT by 3.09 to get its value? If the companies are relatively similar, sure. Just like if I have two houses on a street, one of them just sold for $100,000. It's a 3-bedroom house. And if those two houses are relatively similar, lot size, condition, 3 bedrooms, both of them, I would expect that other house should be able to sell for the same $100,000, right? I'm going to use its bedrooms and to identify its multiple. Okay, those are comps. And we do the exact same thing with businesses. We call them enterprise value multiples. And different companies should use different types. For example, I referenced the company a few minutes ago that doesn't have a positive EBIT. It's early stage. Well, we wouldn't value it based upon EBIT because that would be negative, right? We might value it based upon its sales. So we might use a sales multiple. A very mature company with a positive EBIT, with understandable known depreciation, we might use an EBITDA multiple. One that's heavily reinvesting in itself, we might use a free cash flow multiple. So at different kinds of businesses in their different stages of life cycle, we might use a different type of multiple for them. But it's just a comp, no different than $33,000 per bedroom or $250 per square foot or whatever it might be. These are just comps. Well, how do we turn these multiples into models? Well, if enterprise value divided by EBIT equals some multiple, M, then that multiple M times EBIT should equal an enterprise value, right? Think of this almost like we do a forecast ratio, because it's just a ratio, right? If we know what the ratio should be, and we apply it to a future period's EBIT, we know what the value of the asset should be based upon its future EBIT. And EBIT is one of our cash flow inputs, isn't it? So we go from using a multiple and we turn it into a model by just rearranging it. If this is EBIT or enterprise value at times 0 divided by EBIT at times 0 gives us a multiple, a ratio, then we can take that ratio times EBIT from time 1. And it should give us our estimated value or our estimated enterprise value. And if we're doing it for right now, so we're not using any future cash flows, we're just doing it right now. The company's EBIT for next year is expected to be 100. We know it should have a multiple of 10. Then that means the company's value based upon the next year's cash flow should be 1,000, right? We apply it right now. Kind of sounds like we're creating another continuing value, doesn't it? Only this time we're not using the Gordon growth model. And we can apply this form, the multiple times whatever cash flow variable, whether it's sales, EBITDA, free cash flow, EBIT, operating, whatever it is, you can use that in place of a continuing value. It's not a salvage value. It's not a value based on the Gordon growth model, but it is a value at that point in time. And the only thing we need to be careful about is that we use the right multiple, which we'll talk about in a moment, and we use the EBIT or whatever the cash flow variable is that we're using for the next period. So if we're using it as a continuing value, it would be for the year after the explicit period. And if there is no explicit period, it would be for this next year. Does that make sense? We'll talk a little bit more about why we use these and why they're important here. But I'm going to tell you that if you've ever watched Shark Tank, you've watched people doing this. Those 4 or 5 people sit up there and they talk about the cash flows and they have in their mind some multiple of cash flow. A company should be worth, most of them are looking at 2.5 times cash flow. Maybe an exciting company 3 times cash flow. That's what it should be worth. That's its enterprise value. Notice how they get really upset when they find that a company already has debt. Might come across Carol's company and they might say, okay, we'll agree on a $5 million valuation. And then somebody says to Carol, do you have any debt? And Carol says, well, there's $3 million. And Kevin O'Leary throws up his hands and says, oh my gosh. They get all upset. Why is that? What's the issue there?
Most of the value of the company's tied up in debt.
A lot of the value of the company is tied up in debt. Remember that we can estimate enterprise value using one of our models, or we can calculate enterprise value using enterprise value is equal to the market value of the capital, or the market value of the common, plus the market value of the preferred, plus the market value of the debt minus cash. So if we look at this from a very simplistic standpoint and say the company has no excess cash, so we're going to hold cash at 0. And if we say it's got a valuation, an estimated valuation, which is synonymous with an estimated enterprise value, it's estimated, not calculated, estimated it. If that's the case, if it gives us a $5 million valuation, and now we realize that $3 million of that's tied up in debt, that means there's only $2 million available of equity, right? So we have to think about estimated enterprise value being synonymous with the estimated values that we're coming up with. And then we might use those values in the enterprise value equation as to substitute what the enterprise value is. So in this case, 5 million equals equity plus 3 million of debt, which means there's only 2 million of equity left. We do a little reverse engineering, right? Let's go a little further. So I ran these numbers for you just a moment ago, so I don't have to do those again, except for I showed you how we got the 3.09, but now let's use that 3.09 on next year's EBIT. So I'm going to Mira Dravana. I've done my value without. Where are my EBITs here? And I've got EBIT for the base year of 51.063. I said it's next year, it's not, it's the base year. And so that 3.09 times 51.063 gives me the enterprise value that we calculated. Fair enough. Now I want to use that for a future period. So if I've identified that the multiple should be 3.09, and by the way, I observed this for the company, right? I saw that in the base year, that multiple, the enterprise value divided by the EBIT, was 3.09. So it's observable, it's historic, it's got to have some level of credibility. I may like it, I may not like it, I may want to change it, but it's got some level of credibility. We saw it with our own accounting eyes. If we now apply that 3.09 to the next period's EBIT of 66.893, we end up with a value of 206.7. That's greater than 157.75, right? We applied next period's EBIT, multiply it by the model or the multiple to come up with a new value. It's kind of like, it's a broad brushstroke. It's kind of like applying the Gordon growth model is also a broad brushstroke. We take a single cash flow variable, free cash flow for next year, and we divide it by R minus G. That's a broad brushstroke. We're using a single cash flow variable. In this case, I'm using EBIT. Could just as easily use FCF or EBITDA. The multiple would be different, but the concept would be the same. And I come up with a number. And just like using the Gordon growth model, it's extraordinarily simple, but its simplicity makes it easily used and makes it error prone because it's just too basic. But it's a place to start, right? And this is what the guys on Shark Tank are doing. They are talking about cash flows, cash flows, cash flows. They come up with a cash flow, and then they write something down. They multiply it by 2, 2.5, 3, depending upon how excited they are about it, how much growth they think it has in it, and they come up with a number. And then they tell the person that their number is all whacked, and that this is a better number. See it happen every time.
Hey, Rick. So
Yep.
I just have a quick question about this, just to make sure I follow. So you're getting your multiple by taking your enterprise value, or you're getting it with your enterprise value and your EBIT. What you're doing in this slide is then you are applying that multiple to, I guess, the next year's EBIT. So when I say next year, I mean year one, the prior year being the base year. And then and that 206.70 is your enterprise value for what? Year one?
For year zero.
Year zero.
We always think about the construction of the Gordon growth model, which started as P0 equals D1 divided by R minus G. So it's always some cash flow that happens next, interacts with some other variables to give us the present value now. Well, the enterprise value at time zero should be, so the value now, estimated value now, should, in this case, is a function of the next period's EBIT, which is one of our cash flow forms, interacted with this multiple. It is a continuing value.
Will you, I think I follow you. I think where I'm getting confused. Will you go back to the Mira Jirvana,
Sure.
where you showed how, like the original multiple, how you showed that we had that? The actual, yeah, there we go. Okay, I gotcha. So what I was looking at there, I think I was thinking for some reason that 157.75 was the EBIT, not the enterprise value.
Got it. Yeah, the EBIT was 51.63 or something like that, Matt. Now, this is an observed multiple, this 3.09. And it's taken by dividing this 157.75, which is the enterprise value for the base year. And we divided it by the base year's EBIT to get this 3.09. But it just gives us a place to start. It gives us an observable point, right? And if I look at this company, and if I find that every year for a string of years, its enterprise value divided by its EBIT was about 3, then I now have an observable value. I have an observable multiple. It's got some consistency to it. I have history, precedence. Okay. Well, here we've got some different types of multiples and the different stage that companies might be at as they're thinking about applying these. And if I were you, this is on Canvas, of course, linked for this week. I would, in thinking about multiple forms, I would make note of this slide, or I would copy this slide, or I'd screenshot this or something, because this is useful. You use this again. These are just different forms of an enterprise value multiple. Sales multiple, EBITDA multiple, EBIT multiple, free cash flow multiple, with some brief notation as to what kinds of companies. Early stage ventures that aren't profitable yet, we'll use a sales multiple. Firms with really good operating income but significant capitalized assets, which means a lot of depreciation, right? We'll use an EBITDA multiple. Firms with good operating income but without a lot of operating assets, so not much EBIT, maybe none at all. Think of a service-based firm or services software firm. We'll use an EBIT multiple. But firms with really good operating income and capital growth plans are going to use a free cash flow multiple. So different multiples for different points in a company's life cycle, various types of companies. Where do we get those multiples? Well, I indicated that we can look at them from our own company's history, right? Mario's the CFO. He's been tracking this for the 7 years we've worked together, and he sees that every year we run about a 3.09, 3.1, 3.15 or so multiple when we divide our estimated enterprise value or our observed enterprise value divided by our EBIT. So it's run pretty constant, Mario. You're doing a good job of maintaining balance in this for our company, okay? But we might find them other places as well. So let's say I'm looking at Taft Enterprises. And Taft Enterprises is also a European economic consulting firm. Taft in this case isn't Eastern European, it's British. That sounds like a very British last name to me, Taft. And so we can look at this and we say, well, you know, I know Taft Enterprises out there. The multiple that they get when they consider their enterprise value and their EBIT is a much bigger multiple than the one Mira-Dravana gets. They're both European economic consulting firms. Why would one of them have a different multiple than another if we're using the same cash flow variable? What's at heart there? What's the issue?
Is it like their basic, like their values from EBIT and stuff that's pulling up their statements?
I'm not sure immediately the relevance of that. I was thinking about maybe having an aspirational target, Mandy. So if Taft is growing faster than Mira-Dravana, shouldn't Taft have a better value than Mira-Dravana? Let's say they both have $1 million in billings, but Taft is growing faster, which means next year's billings will be more than Mira-Dravana's if it's growing faster and if they both have $1 million now, right? Wouldn't Taft then have a higher value to us?
I mean, I guess so, but it just depends on the big picture. Is the other person going to be the turtle that just has just as much cash flow over time?
Well, let's assume that Taft is growing faster and is going to continue to grow faster. I mean, don't undercut your own company, Mandy. You're not being a very good CEO here. Okay, you're going to say, of course, Taft is more valuable. But think about it. In our income-based models, when the cash flow grows at a faster rate, it gets bigger. Bigger cash flows mean more value, right? So if both of our companies start out with the same $1 million in cash flow, only Taft is growing faster than Haskell or Mira-Dravana, Taft should be able to command a higher market value. It's going to have a higher estimated value.
Absolutely.
Say again?
I said absolutely.
There you go. Absolutely. So think about this. A multiple tells us as much about the company's expected future growth as it does anything else when you're comparing two companies. And if you see that one company is being given a multiple of 3 and another company is being given a multiple of 4, the company with the multiple of 4 has a higher growth component than the company with a multiple of 3. If it was 2 instead of 4, there would be a lower growth expectation. Some of that's commonsensical, maybe not all of it, but we can think about aspirational targets. So I know that I'm thinking about buying Mira-Dravana. I like it. In fact, remember that I'm one of the guys that works for Schmidt Enterprises, the Schmidt Capital. We're going to buy Mirror Nirvana, and its multiple right now is 3.09. But if I know that Taft Enterprises, which is a very similar company, is being able to move at a multiple of 4, I might aspire to be able to make Mirror Nirvana more like Taft. Better management, better profit margins, better growth, better ROIC, bring all the things into line, in which case I should be able to create more value there, which is going to be reflected in a higher multiple. So I'm going to aspire to a better multiple. I look at Bella Incorporated, and Bella Incorporated has just killer management. Yeah, it's in a slightly different part of the market. It's not just a consulting firm, but it's a services firm. And Bella Enterprises has been able to command a multiple of 6 in the open market. I want to take Mirror Nirvana and make it more like Bella Enterprises. And if I can make it more like Bella Enterprises, I should be able to command a higher multiple. We'll talk in a few minutes of what those measurables might be to think about making it more like Taft or more like Bella. But if I can be more like Bella or more like Taft, I can have a higher multiple and my company's value should be higher. Okay? And then there are comparable values. I might go ahead and look at the different economic consulting companies operating through Eastern Europe, and I might look at those that have sold or had a transaction in the last 2 to 3 years, and then I might see what the multiple was on which that transaction was based. And I might take the average of those because my company, Mirror Nirvana, is just another economic consulting firm in Eastern Europe. And if the others averaged a multiple of 4, then maybe I should be able to have a multiple of 4 instead of the 3. So I might be able to revalue the asset. Those 3 ways of thinking about where the multiple comes from are the 3 most commonly held ways. We look at the company's history. We look at our aspirations of others in the industries that we're in or somewhat similar industries that we can become more like if we make some changes. Those are aspirational targets. And we look at comparable values. What other companies that have sold or transacted in the market recently, and recently maybe the last 2 or 3 years, and we look at their multiples based upon whatever the cash flow variable was. And if we think our company truly is comparable to them, then we can apply those multiples. Let's say I've got Schwartz here, and Michael's looking at this, and he's saying, yeah, Rick, you're putting a multiple of 4 out here for Taft Enterprises, and 3 for yours. And I will say, yeah, you're very similar. So I can see that. Taft has got a better profit margin, has better growth prospects. It's because of the way they've run the business. But now you're looking at Bella Enterprises, and you're applying a multiple of 6 to that. How can you, it's not the same company. It's not exactly like Taft. It's only kind of similar to Mirror Nirvana. I'm applying a 6 times multiple to it. And I might say, well, Michael, you're right. I'm applying a 6 times multiple. I think I can get there with mine because we're enough alike, or I'll make some adjustments. Yeah, hers is 6, but we're not exactly the same. Maybe I'll adjust it down to 5.5 for my own. Historical multiples, aspirational targets. Historical come from our own company, by the way, our own past. Aspirational targets, companies that we want to be like, and comparable values, companies that have transacted in the marketplace in recent years that we can observe multiples for them. Those are the 3 most common places we're going to find our multiples. Any question about this yet? Okay. Well, there's another way. We can actually use a piece of algebra, a fairly complex piece of algebra to be sure, but we can use a piece of algebra to calculate a company's multiple. So we'll spend a couple of minutes looking at that. So I think you're looking at my my PowerPoint, right? Okay. So if I take and I want to find the equational form of the sales multiple, what I'm going to do is go to the KVD form of continuing value. I'm going to walk you through something here for a moment that's going to end up focusing on EV/EBIT. and the algebraic elements of EB/EBIT. So how did I get there? You have to walk through this with me for it to make sense. It's kind of like a mathematical proof. Would we agree that an estimated enterprise value could be no plat times 1 minus G divided by ROIC divided by WACC minus G? Would we agree with that? Isn't that the continuing value using the KVD form? And didn't we agree earlier that that's an expected or an estimated value at that moment in time? Yeah. So I want to take and I want to make it look like EV/EBIT instead. How do I do that? Well, I remember that no plat is just EBIT times 1 minus tax rate. And if I divide both sides by EBIT, now my left-hand side is EV/EBIT. My right-hand side looks different, but I'm going to morph that with some little algebraic sleight of hand until it looks like this line down here at the bottom. I'm going to go ahead and move the 1 minus T off to the right-hand side. I'm going to recognize that 1 minus G divided by ROIC. Well, 1 is the same thing as ROIC divided by ROIC. That's 1. So I now have moved the 1 minus T to the right-hand side. I've gotten it out of my denominator or my numerator. I'm changing the format here. ROIC divided by ROIC is equal to 1. I am subtracting from that G divided by ROIC. In my next one, I'm just simplifying that a little bit. And now all I'm doing is inverting the last part of my equation such that EV/EBIT now EV/EBIT now looks like ROIC minus G divided by ROIC times WACC minus G times 1 minus tax. Now, the only reason I went through that, the only reason, is to give you the algebraic proof if you really have a pathetic enough life to really want to go through the algebraic proof, and to show you, to prove to you that this multiple, EV/EBIT, looks like enterprise value divided by EBIT, but its algebraic components are ROIC, return on capital, growth, WACC, and the tax rate. And anything that goes into making those up. So if I now want to think about that aspirational multiple, let's say my EV/EBIT was 3 when we looked at it historically, but I want it to be 4. I want it to be like Taft Enterprises. How do I get it to be 4? Well, I look at Taft Enterprises, and maybe Taft Enterprises, as I said, simply has a better growth rate. Notice that growth is in both the numerator and the denominator. Growth is the most dynamic of the variables in the algebraic form. So I said it tells us a lot about the growth prospects of the company. If I can grow my company, maybe it can look more like Taft Enterprises and can have the kind of multiple that Taft Enterprises have. Or maybe if I can improve my ROIC, which, by the way, is tantamount to growing the company's revenue without growing its capital base, then maybe then I can get a multiple of 4. Or if I can decrease the WACC, maybe then I can get a multiple of 4. Think back to the DuPont identity for calculating return on equity. You know, return on equity is net income divided by total equity, right? Well, we also know it's profit margin plus total asset turns plus equity multiplier. It's the disaggregated form of ROE is seen through the DuPont identity. The disaggregated form of an EV/EBIT multiple is seen through the KVD formation. So if you tell me, if the chairman of the board, Diana, walks in and says, Rick, you have got to bring about a higher multiple for the company, and walks out, if I don't know the disaggregated form, then I think that Diana really just gave me my pink slip, right, Diana? Because if I don't know what to do, you're going to get rid of me, right? But I know the disaggregated form. I know if I can improve my ROIC, which simply means growing my top line faster than I'm growing my capital base, I'm going to go ahead and improve my multiple. Or if I can shrink my WACC, I'm going to go ahead and improve my multiple. Does that make sense?
No, but we'll figure it out when we get there.
Well, sort of. Just think about it like this, and Matt, I appreciate the candor. Think about it like this. From a managerial decision standpoint, if I say, Schmidt, improve the multiple, you turn around, you say, sure, Rick, and you turn around and you go bitch about it to Andrew, because I might as well have told you just move the Great Wall of China while you're at it, right? But if I say, Matt, you can improve the multiple by decreasing WACC, let's go ahead and do some financial engineering and decrease our company's WACC. And if you'll know that's going to improve the multiple. Now you've got a fighting chance as a manager, right?
Right. I think, maybe to elaborate on just my simple note, doesn't make sense, is I think conceptually the point is that if you understand how the math makes up the multiples, you can figure out what components need to be manipulated to change those multiples, I guess. Right? I say no in the sense that I'm not sure I follow all the different detailed levels of the math, but I think, that's why I say when we get there, I'm sure it will, is I think going back to like the previous slide, it seems like that's kind of what you're trying to also impart on us, is you may have these multiples, but these also equal, I guess, and that was one of the questions I was going to ask, is like EV over sales. The equational form for that is, what you have to the right there.
Yep.
You're basically saying, some of these values that we use in are a combination of multiple other values we've calculated as a precursor to. So it's kind of just understanding, the mechanics, so to speak, of the equation, I guess.
Yes. That is exactly right.
But I think as it pertains, I guess, the assignment, I assume that, these multiples come in when you're factoring not necessarily cash flow, but estimated value based on your cash flows, right? And choosing, maybe not even your cash flows, but choosing the right one based on, if they have cash flows, if they have EBITDA, if they have EBIT, if they have sales, and knowing which one to use, so that not only are you using the right value, but you're basing it off of what your inputs are to begin with.
Yes. So we're going to run through an example numerically of this in just a moment. Okay? Well, I've given you this algebraic proof just so you'll see that these are the component parts. Okay? I just want you to see these are the component parts that make up this very simplified multiple. And we can run some numbers. And since I'm not holding you responsible for the algebraic proof, I'm not going to hold you responsible for engineering through the proof. So we're going to bypass this slide. And if you want to look at this slide and want some more guidance on this, feel free to ask me about it some other time, but we're not going to do this as a class. So now I want to think about using the multiple in either a single stage model or a dual stage model, multi-stage model. Remember I told you last week the difference between those. A single stage model might be one where we simply come up with a continuing value. So I'm going to go to Mirajavana for a minute, and we'll think about what a single stage model might look like. No, that's not, that is it. So I might say, I'm just going to put something down here. I might say that Mirajavana value is going to be equal to the next period's free cash flow divided by its discount rate minus its long-run growth rate. That would be a Gordon growth model. And if I said that, look at the difference in value. Is 36.81 instead of 600. And I took free cash flow from next year divided by R minus G, And it gave me 36.81. I'm going to call it 37 instead of 600. Why is there such a dramatic difference between those?
Because you didn't take into account any of the other potential years of cash flows. That's only 1 year's cash flow.
And the growth that I was attributing to the future years was only 2.5%, right? Whew. I would have been better off just using, like my continuing value, the free cash flow from the year after the explicit period, dividing it by WACC minus G, and then discounting it discounting it back to today. 575 is a whole lot better than 36.81. I point this out just to show you that when you simply use a single stage model, they are so overly simplified as to be terribly error prone. Now we know that in this case, that 36.815 is terribly undervaluing this company. But we really only applied a 2.5% growth to it. What if we were willing to apply 15% growth instead? Well, now I've got a problem, right? Why did I turn negative? Because growth was higher than WACC. Okay, maybe I should have thought about this in terms of only a 12% growth. Maybe it's not going to be 31% for the next 5 years and then 2.5% thereafter. Maybe I can just generalize and say it's an average of 12. Well, that would tell me the company's worth 2,000. Well, that's a lot more than I've been calculating, right? Excuse me, company's worth 178. That's not even close to what I've been calculating still. So this growth rate that we've been dealing with is one of the most dynamic elements of the Gordon growth model. And when we're applying a singular value to such a dynamic variable, we either are dead on right or we're off the map wrong. This is what the sharks are doing.
So the Gordon growth model is an example of a, would you say single
stage model.
Single stage model. And just to reframe what you said in my own words, make sure I understand it. The concept is that because it's so simple, if the input is off, it doesn't have enough complexity in other variables to account for any buffer in your error.
Or
basically.
any mitigating factors.
So it's very binary. It's kind of all or nothing.
It's either dead on right or it's screwed up wrong. Okay.
In all of these, so Gordon growth, my follow-up question is, so is KVD, I assume, is also I don't know. Is it a single stage?
If I was only using the continuing value form here as a single stage variable, I would say equals my no plat times 1 minus my G divided by ROIC. I divide that by, where's my WACC? WACC minus G. I must have messed something up there. Excuse me. Let me redo that. I apologize. I could just take my no plat for the next period times 1 minus G divided by ROIC. And now I'm going to divide that by WACC minus G. Now that's interesting. When I used a single stage model that was simply my free cash flow divided by WACC minus G, I got a very unsatisfying value, right? Mm-hmm. By the way, I think I may have a wrong value. No, I'm good. But when I expanded this, made it a little bit more complex, brought in some other variables that are dynamic, I'm still nowhere near 600. but I'm not as egregiously off anymore.
And that's because you're using the ROIC and you're not just doing WACC minus G.
Exactly.
The is more complex. So therefore, you get more, it's more complex to calculate, but you have a higher, I don't want to say degree of accuracy, maybe
That's what I would say. It's exactly what I would say. Oh, we're still wrong, but we're not as wrong as we were. Okay. When I bring into the equation more of the dynamic driving variables, I get closer and closer to a better number, more accurate number. Well, that doesn't surprise you. That kind of makes sense in just a critical thinking aspect. Now let's think about this with respect to a multiple. So I'm going to come over here. I'm just going to put a number here. And I'm going to say, well, let's assume that for whatever reason, I believe this company can have a multiple of 5.6. Now we know already that we observed a multiple of 3.09 in the base year. So if I'm saying I think we're going to have a multiple of 5.6, one of two things must be accurate. No, maybe one of three things. Either historically that 3.09 was very low, or we see that other companies not unlike our own but better managed, like Taft Enterprises and Bella, are running at a higher multiple and we aspire to be like them. Or we see that companies that have had a transaction within the marketplace in the last few years have sold for a multiple of closer to 5.6. History, aspiration, comparables. One of those three or all of those three in concert have caused me to believe, for whatever reason, that I should be able to have a multiple of 5.6. And if I simply divide that, multiply that by the EBIT that I've got for my next year, I come up with 374.598. Well, that's interesting. That's not much different than the KVD one gave me. How come?
Because you're using the same level of complexity in your equation, I guess.
Well, no, you don't just guess. You, in fact, have an algebraic proof telling you I am. The EV-EBIT multiple is an algebraic rearrangement, of the KVD equation term.
Yep.
So it would have been shocking to us were they not so similar. Okay. Well, I like that. That makes good sense to me. In my own little twisted way, maybe, but it makes good sense to me. Okay. But still not close to 600. Why are we so far off the mark? 373 versus 6, 374 and a half versus 6. That's a lot different, right? Because these sixes, this one and this one, I'm calling them 6 because they're so close to it, also has the benefit of all these other cash flows that aren't being taken account of in these single stage multiples. This is the reason we use a multi-stage model where we have, to be sure, a continuing value that's based on a single stage, simple or otherwise, but we also have the benefit of all these surplus cash flows in the interim. That's why. So now let me tell you about the forward market multiple model. This utility of a multiple is simply a multiple as a model. The forward market multiple model uses the exact same free cash flows. It uses the exact same WACC to get to the discounted cash flows. Notice that the present value of the discounted cash flows is all the same. But our continuation term is different. And what's our continuation term? It is the multiple that we have somehow identified multiplied by the EBIT for the next period that we're calculating for. Gave us continuing value. We then discount it back. We then add it to the value of the present value of our other discounted cash flows. I got to change something here because it's weirding me out. Got to put those back to our KU and K-tax numbers because we were looking at this as 612 and it kept bugging me. So notice that at a 5.6 multiple, we've gotten roughly the same numbers, 600, 600, 600, and 600 as our other forms. Applying only a single stage multiple, grossly undervalued. Now, if I applied a single stage multiple with a high enough multiple, it wouldn't undervalue. Remember what I said we're missing when we use just the Gordon growth or just the KVD? We're missing some of the dynamics of growth. And remember me telling you that the multiple itself is a growth instrument? If I move this up to maybe 8, will it get me close to the 600? Maybe closer, maybe 9 is closer. Yep, 9, a multiple of 9 applied in a single stage multiple would have gotten me close to that 6. But a multiple of 9 would be reflective of a higher growth rate. Well, what growth rate were we looking at when we used just the 5.6? It was reflective of a much lower growth rate. So the multiple tells us more about growth than it does virtually anything else. And again, we can see that because we see the growth variable in both the numerator and the denominator of the equation. It's more dynamic.
So will you show again real quick, Rick, how you got the FFM model CV?
Yep, very simple, very simple. I took this multiple that somehow I'd come up with. Maybe it was comparables, maybe it was history, maybe it was aspiration. It was 5.6. I multiplied that by EBIT in time one of my continuation. It gave me the continuation term for the forward market multiple model. I then take the present value of that, add the two present values together, and I get a number of about 600.
Gotcha. And so I guess, so that I just wanted to clarify that before I ask my next question. So it sounds like the real, I don't know, maybe it's just how my mind's working, but the trick is how do you get that multiple? How do you get that target EBIT, right? Because, and I guess my question is when we go to do this, I mean, we talked a little bit about, you've got to, like in the real world, you've got multiple types of multiples that you could apply based on the type of company. But I guess my question is, how would we go about calculating that 5.6, or is that just a variable that we're going to anticipate is given?
Well, or you're giving clues to or something. So let's look at the next problem set, okay? And let me confirm which set that is. That's what I thought. So we're looking now at the forecasting value DCF KVD, and you'll see that as we work through this, I believe one of the last things I ask you to do, I hope I'm right, is motivate the FMM model, okay? So you're going to have to be given some kind of clue as to what multiple to use. So in this case, let's read through this some. And in this case, we're given some information. We're given, but none of that's about a multiple, just some background. We're given some more background. We're given some dynamics of change. We're given some other costs. The only place we ever see a multiple come into play here is through the history of the company. We can calculate it. And notice here that when I do this, I tell you that we calculated it from the base year, and we saw that EV/EBIT for the base year was 12.76. So if that's the only clue I've got, then I can use that, right? Because it's history at least. It's some credibility for our company. And so I'm going to apply EBIT from year one in the continuation EBIT, in continuation year. And here's my EBIT in my forecast. So in year one is 2020 in this case. So 13.459 times 12.76 equaled 171. So in this next one, you will use the observed multiple from the base year as your multiple. The last problem set that you will do is on Leland Manufacturing. And I'll tell you right now that you have the problem set for Leland Manufacturing. You don't have the solution set. There's several interpretable items there, and I'm looking to see how you interpret them, and I want you to have lots of latitude, okay? But you'll find I tell you that similar companies in the prior year had gone for a multiple of 32. Our company in prior years had an observable multiple of 17. I give you a number of different inputs, aspirational, comparable, historical, and let you decide which one you think or what number from those you're going to use. But that'll be the last problem set that you'll do. Okay? Okay. Any questions about this yet? Try to keep the multiples simple. If you overcomplicate them, then they're a problem. And remember that if you get stuck, you can always calculate one algebraically. If you know the company's ROIC, you know its WACC, you know its tax rate, you estimate a G, you can come up with a number that is a multiple, can't you? We good? Does that make sense? Okay. So unless you have other questions, what I want to do now is I want to transition and talk about your course project.